Hi, and welcome to Weldon Live for Wednesday, January 4th. A lot of ground to cover, as always. U.S. macro data and an FOMC bombshell within the minutes from the December meeting. We'll take a look. That fosters and basically supports the rise we see going on in yields, which is clearly focused in the short end when we break it down and look at the yield curve. Chinese renminbi in the headlines as talk that the officials in China may be looking to stem the potential for capital outflows on the thoughts that potential sanctions from the new U.S. president could wreak havoc on the Chinese currency. Stock indexes, banks, and what's interesting about this, as the regional bank ETF that we recommended the day after Donald Trump won the presidency back in November, is actually breaking down relative to the EU Euro Stocks Bank Index. Wow, isn't that a surprise? We'll take a look. Gold showing signs of life. You're going to want to check this out if you're into gold. Really interesting charts today. Energy markets, we prep for tomorrow's all-important first 2017 data from the DOE on supplies. Gasoline is in a position to potentially benefit. And in the ag CRB, one day after we previewed it for 2017, you have a big upside day and a breakout. In terms of global macro, we start with yesterday's ISM manufacturing survey. Clearly signs of intensifying and broadening commodity price inflation in terms of commodities up in price versus down in price, and even short supply. Electronic components for the first time showing up in that sector. That's interesting. The comments you can find in our chart pack today, very positive. All of that leads us to the highest headline activity index reading in 2 years. Not only that, but above the 5-year average, which you see is now turning up with a series of higher lows and now higher highs. So from a technical perspective, this is something of a breakout in the ISM, which is great for the manufacturing sector, which has clearly been a laggard. New orders. Second consecutive month where the percentage of firms saying that new orders are rising was higher, and as a result, you can see the index above 60, with 12 industries reporting growth against only 4 reporting a decrease. So that's clearly very well skewed towards the strength side. In that context, the reading in the new orders index above 60, also the highest in over 2 years. We note production, very big increase here in terms of 3 months now in a row where the percentage of firms saying that it's greater has been on the rise, with, again, a very heavily skewed percentage of, not only percentage of industries, but actual industries themselves. 10 reporting growth against 2 reporting a decrease. We see that pretty much across the board in yesterday's manufacturing ISM survey results. The production index above 60. It's into the go-go area, above 60, and also the highest in over 2 years, now above the 5-year moving average for the first time in over 2 years. And we note the 5-year average here turning up directionally on the back of the strength here seen for the month of December. We also note employment. It's kind of static. I mean, the percent saying employment is higher continues to be lower. Lower than you might want it to be. But from this perspective, the index is kind of increasing as the percentage of firms basically laying off workers continues to fall. And this was something that was actually noted in the beige book, which we'll get to, in the Fed's minutes, which we'll get to in a minute, that less layoffs are clearly a dynamic here, characteristic of the improvement in the labor market. And from that perspective, you see kind of a medium-term breakout above this downtrend line. It goes back to the middle of 2014 in the employment index. Also here as well, an upturn in the 5-year average. In terms of prices, here's where we see it. Really is notable from 20 to 38 in terms of the percentage of firms saying they're being charged higher prices for their input materials against a halving to a very low number of only 7% of firms saying they're paying lower prices. As a result, the index really has soared to 65.5, with only one industry reporting paying lower prices against 14 that are saying they're paying higher prices. That's obviously a skew to the upside. Clearly, within the ISM manufacturing survey, we see intensified signs of commodity price inflation. In terms of the 1-month lag in construction spending data, it's the first month of 2016 where you had higher than expected growth. You have repeatedly not only been below expectations, but in most cases, most months, outright negative numbers. So that's a shift. We also note again in the Fed's minutes, comments about the increase in residential investment. So that a positive. We see increasing signs of pickup in capital investment, residential investment, something that has kind of sorely been lacking in the second half of 2016. The caveat to all the strength that we're seeing continues to be the impact of rising interest rates on the mortgage sector. The refi index bounced just barely in the most recent reporting week and is bouncing from what was a week ago an 8-year low. You can see the downturn here in the 2-year moving average, the double top at the 38% retracement, so on and so forth. Technically speaking, this is a really, really ugly chart. And within that context, this is clearly a long-term breakout. As we know, so it's now not going to shock anyone, the breakout in the 30-year fixed mortgage rate. But what's interesting about all this is the real hardcore positive correlation, actually negative correlation, but the positive correlation in the sense that rising mortgage rates beget higher refinance activity, and the flip side of that. So from that perspective, the rise in mortgage rates clearly having an impact in terms of demand for refinancing loans. And then finally, within today's FOMC minutes, really not much new, but what was new was quite notable. Continued intensified language around the strengthening in the labor market, number one, close to consistency with the maximum employment objective, something we've heard from the Fed before, but these words are pretty specific in terms of kind of how close the Fed feels they are to where you'll start to see an intensification of wage inflation, and that is something they're very much in tune with, to the degree that they actually discussed the potential scenario where a less gradual pace of increases could become appropriate. In other words, a more hawkish approach to rate hikes down the road. That's really interesting. That did have some impact on bond prices today. You see the 2-year Treasury note yield really just probing, flirting with this 35-year downtrend line, which is so important. We look at a close-up of that. Any real kind of sustained move above the 132, let's call it, yield level in the 2-year would clearly be a long-term breakout. Note also that the moving averages here, this is the 52-week and 2-year moving averages kind of widening this higher yield trend. So the trend picking up steam. We already know that the 5-year Treasury note has violated that same 35-year downtrend line. In fact, above the 5-year moving average, which is now turning up here on the monthly chart. So from that perspective, it's interesting to note how it's kind of become focused in the short end, and maybe some thought process to, a more hawkish approach from the Fed could actually squelch inflation before it even gets started. I mean, that's kind of what the read would be here from the fact that the yield curve is on the verge of breaking down. Here's the 30-year, 5-year tranche of the yield curve. I mean, it's close to a new multi-year low with a downtrend. I mean, it's kind of a corrective steepening move, and now on the verge of breaking down to new multi-year lows and potential to extend and intensify a trend towards flattening. In foreign exchange, clearly the renminbi is front and center in terms of the headlines. Fear of Donald Trump, some talk about maybe the push has gone a little bit too far here and may have the chance to kind of get a little out of hand. Has more domestic Chinese investors talking about kind of maxing out their legal ability to move money offshore. The percentage of Chinese households saying they want to get 10% of their money invested offshore is now at a new high, at above 55%. A lot of headlines today, but the bottom line is, to me, this kind of rhetoric always seems to appear when you get to a level of depreciation in the currency that seems enough in a medium-term perspective. We've seen this before. One of the things we watch very closely is the 12-month non-deliverable forward, and then the relationship to the spot rate. And you can see that most recently was challenging the highs that you saw back in January of 2016. So from that perspective, not surprising to see the pickup in rhetoric around this story. The same thing, too, if you go back to really the summer, when we were down here around 663, 664, we put out this exact same chart targeting a move to 680 to 691 based on kind of this stair-step move higher in the US dollar, and you've overshot that now. So again, kind of not surprising to see this kind of rhetoric because this has become maybe a little more intense than the authorities might feel comfortable with. From that same perspective, the year-over-year depreciation, so meaning higher here is depreciation in the Chinese currency, I mean, it's above 8% as of November. That's something we haven't seen in a long time. Really got to go all the way back to the pre-peg period of currency devaluations, outright devaluations in China. So from that perspective, again, not surprising to see all this rhetoric. You've overshot our target. Recall our January of 2015 piece on the Chinese renminbi and how it was going to join our 2014 theme of peso wars when currencies really started to come unglued, particularly in places like South America and the former Soviet republics. And from that perspective, our target was 682. And you're well beyond that. You're approaching 7. And from a psychological standpoint, again, not surprising to see the rise in rhetoric. We feel, though, that any decline in the dollar here, any rally in the renminbi, is probably an opportunity to sell the Chinese currency once again. Now, 5 o'clock in the morning, U.S. stock market's down. It's the morning after the Trump victory in the election, news starting to get out. We tweeted this exact panel here, what our conclusions were. Basically, long the banks, long the industrial metals, and short the bond market. Also throwing in a bullish energy position. Well, for sure, the bank end of that, along with the bond end of that recommendation, has played out quite beautifully. You can see the near 30% rise and the reach to a new daily closing high today in the regional bank ETF, the KRE. You can see the long-term breakout, new contract highs for this ETF. Which came into existence back in 2006. And from that perspective, now the continued and intensifying outperformance relative to the broader U.S. stock market. It's almost 40% over just the last 6 months, and you got to go all the way back to 2009 to get a level of this, level on the ratio spread of the KRE relative to the S&P 500. But not only that, but the broader, more big cap banks, the KBE, the ETF here, also at a new closing high. You can see a very well-defined weekly pattern with the big breakout here off the election. 43% outright appreciation here. And outperformance here also as well against the S&P 500 breaking out in a long-term pattern. We expect this trend to continue. Now, what's really kind of maybe a little surprising is the high-powered performance we're seeing in Europe on the back also of rising yields. We got a rise in inflation. We talked about this yesterday. The push higher in European bond yields kind of being led by Germany, maybe expanding the margins and kind of bailing out the European banks. Well, the Euro Stoxx Bank Index futures at a new multi-year high today. Look at the 100-day above the 200-day, positive on our proprietary oscillator here as well. And you can see this is a long-term breakout from what's essentially a decade-long downtrend line with bullish divergence here and an upturn in momentum. Not only that, possible that the Euro Stoxx Bank Index could be the top performer in the next month to 3 months to 6 months, given this potential. It's not there yet, not completed yet, not confirmed yet, but the potential toppy looking pattern here, unconfirmed, bearish divergence up here too in the ratio spread between the U.S. regional bank ETF and the Euro Stoxx Bank Index. That's something that we'll be watching very closely in the near future. Now, for gold bugs out there, signs of life. The gold bug index of gold mining shares is up 20% very quietly, almost a stealth move, higher from just below the 61% retracement of the entire first kind of big wave move. It's almost a 5-wave down move to the 61%, but you're on the verge of potentially breaking. I mean, you have some overhead resistance, no doubt, it kind of all this, again, predicated upon the dollar, but it's interesting to note how the the gold mining shares are up almost 20% in just a matter of a couple weeks. And really kind of more telling is the fact that they're outperforming the price of gold. I mean, you held in around the 50% retracement on this spread, the HUI against bullion, and actually above the moving averages, which have not crossed bearishly, talking about the 100 and 200-day exponential moving averages, and the move to a mini new high here. Not only that, on a long-term basis, back above the long-term moving averages with momentum that has never turned turned negative throughout this entire decline on this ratio spread. That's a sign of positivity potentially for gold, given that the ratio tends to lead. It tends to lead to the downside. You can see many instances here, many times when it didn't rally and gold prices did rally. That was a sign of potential trouble in terms of the rally in gold. It was most recently with the pre-election rally, and now it's the flip side of that. potentially a sign of life for gold, as is the fact that the gold-silver ratio has not broken out. Silver has been a very good relative performer, and from this perspective, kind of the breakdown in the gold-silver ratio, which is a positive sign for the sector overall, remains intact. I mean, you're at the 38%. You haven't been able to get above that. The 2-year moving average continues to decline, has held this kind of head and shoulders topping pattern with a stochastic indicator that has remained negative, i.e. positive for the sector. Signs of life for the gold bulls out there. Now, in terms of energy and the kind of the gyrations we've already seen in the last 48 hours, closely watching tomorrow's DOE data on supply, particularly as it relates to gasoline. Gasoline has been in decline now, inventory-wise, the past 2 weeks, previous 2 weeks going into the end of the year, against expectations for the normal seasonal build, which you are not seeing here. Not only that, but the normal year-over-year supply surplus that we see at this time of year in February, okay, coming in, say, the next 4 to 5 to 6 weeks, is non-existent. You're at a deficit. That is extremely rare for this time of year, so we'll keep a close eye on that and how that plays into gasoline, which has been an upside performer relative to this outside-downside reversal day, holding above yesterday's low today with a rally. What's interesting about this is with all these thrusts above 170, you haven't closed above 170 basis the March contract, so anything above 169 here would be a new high daily close, and that would be bullish for gasoline. In terms of crude, we have our eye on the production portion of the DOE report, primarily because with crude oil prices having their big rally, you really haven't seen much putback in terms of output. So from that perspective, the decline in the most recent week, a week ago, takes you back below the 2-year average. So we'll be keeping an eye on that. Crude oil bouncing very nicely off this 55 level. So yeah, that was a pretty damaging technical day, but you're still kind of holding this breakout in crude oil. And in fact, last week's close was 53.89 basis the nearby February contract. If you close above that on Friday, you will basically circumvent what would have been, could have been, an outside-downside reversal week. And you held at the upturning 2-year moving average. That's pretty interesting. We'll reserve judgment for crude oil until we get the data tomorrow. And then finally, we talked about the CRB index yesterday. Could 2017 be the year of the breakout? And indeed, one day later, you get a big move to the upside. You're on the verge of eclipsing this 428.16 level in the cash CRB index with some positive momentum dynamics underneath the market. And from a long-term perspective, that would indeed be a breakout. Now, what's interesting about this is the CRB index here in black against the CRB relative to the dollar in red. Okay, the CRB has not declined outright relative to the rally in the dollar, nor has the EEM, the Emerging Market Stock Index. Bottom line is, this is suggesting that the dollar rally is kind of predicated upon expected macro strength in the U.S. and more rate hikes in the U.S., not intensifying macro risk, and for that reason, not having kind of the negative impact it might otherwise on both the emerging market sector and on commodities, holding out hope that 2017 will be a good year for the commodities sector. That's it for today. Have a great evening. We're back at you tomorrow.